Welcome back to part two of this earnings season. We are going over a few companies.
Hopefully, you have those that did well and don't have, or better yet, shorted those that didn't do well.
Smack that booty and let's move on.
Before we get started, I'd like to go over the OPEC Plus meeting this Thursday. Brent oil futures came down to $81. Brothers from the Middle East met up and basically said, fuck you, United States. We're not going to increase production now.
Yep, even though Biden said if OPEC doesn't increase production, the US might use the strategic petroleum reserve to cool down the oil prices. Do you know what is the expectation from the street? Gas contribute a big part to inflation.
All right, even though OPEC Plus members say they're not going to increase production, remember the sanction Trump imposed on Iran? If that can be lifted at the end of this month, Iran can sell more oil to the US and relieve the high prices. But most analysts still think that the energy crisis is not over just yet. From the mid to long term perspective, we're likely to keep seeing higher prices for crude oil.
Okay, thanks. I noticed recently the financial has been sideways for almost 2 weeks. And on Thursday, XLF dropped 1.3%. Then on Friday, pretty much closed at the same spot on Thursday. While we see a lot of recovery stocks ripping like crazy, this is kind of surprising to me. So I found that Bank of England surprised everyone by not raising rates, which is unexpected by the market.
Yeah, and it delayed the expectation for US to raise rates twice in 2022. We can also see the 10-year bond yield is trending low, also because of the delay of rate hikes.
What this does to the financial sector is that it lowered the margins for banks. And of course, the late rates high is not a good thing for the banks. Simple logic here. Higher rates, more money.
I agree. So, how should we invest in banks now if we want to?
Okay, I'm talking for traditional banks like Bank of America, Wells Fargo, not banks that has an investment banking such as Goldman's and JP Morgan. General direction is buy dips unless there are fundamental changes to the company. For Bank of America, I recommend starting between 43 to 45 and double down if it hits between 40 to 42.
Okay, I'll do Bank of America. I think overall, rate hikes are inevitable, just a matter of time. I'll be patient since the general trend is up for the next few quarters.
Okay, cool. Let's start with APD. Pick the screen for the earning result. This is pretty solid ER with good forecast. I wonder why it did for the past 3 months.
I think it's because back during summer and even before, the raw material and energy prices are ripping and not really dipping. So it raised the cost of companies like APD. It hit them so fast that they weren't able to raise prices in time. So it temporarily showed slow down growth. Once APD starts raising prices, you can see from the start of October, the stock recovered faster than anyone.
Yep, ADP recovered nicely. If you like this company and are looking to add, starting between 285 and 290 for the first level. If that breaks, another level to add is around 267 to 270.
Next one, we have Uber. Check out the screen for their earnings. Their delivery is almost breaking even, so trending basically in the right direction. And Uber also posted an adjusted EBITDA profit of $8 million. This is the first profitable quarter since Uber's IPO.
Looking at their guidance for next quarter, they are expecting adjusted profit of 25 to 75 millions, not meeting the estimate of 100 million. Still doesn't look like it's going to be profitable consistently yet, so no PE valuation.
Uber right now is kind of stuck trading between 43 to 48, and we can't see a clear direction. Well, full disclosure, both of us closed our position in Uber this past Friday earnings. So if you really want to play Uber, make sure you take profits on rips and set stop from the last gap up.
Next up, we have Airbnb, one of the exciting reopening plays. The results are right in front of you. Revenue is up 67% year over year, and this Q3 is their highest revenue ever, beating pre-pandemic 2019 Q3 by 36%. Q3 net income of 834 million marked the company's most profitable quarter ever. These are some good stuff. What about the bad ones?
So even though their gross booking of 11.9 billion is 48% up year over year, but since last year is a pandemic, it's not that impressive and missed estimate of 12.3 billion. And Q3 nights and experiences booked of 79.7 million nights also missed the estimate of 80.8 million nights.
Even though Airbnb is missing some estimates, the overall travel sector is definitely bullish. When you look at bookings, earnings, and other travel stocks like airlines, hotel, right now, the demand is in for travel.
Yeah, I'm definitely down for travel stocks. And also looking at guidance between 1.39 and 1.48 billion, right there with the estimate. Plus, the holidays are coming up, so I'm not worried too much. Tell me what levels are we looking at?
Well, it gapped up on Friday. So first and foremost, any retest from the gap up needs to be supported, which is around 186. If that breaks, for a critical level, we are look at zone between 165 to 175. Airbnb needs to hold this level. If it doesn't break, you can get it as close to 165 as possible and hold.
That sounds good. Real quick, before we get into the exciting AI metaverse part, I want to mention that I will be picking up some small position for PDD for fun. Since next week is China's Double 11 holiday, what's the deal? You down?
Oh, definitely, I'm down. Double 11 is like a nationwide Amazon Prime Day in China. The total sales on this day alone were 332 billion rand last year. That's roughly 50 billions in US dollar. I'm sure we will see a new record number this year as the Chinese consumer spending power is getting stronger and stronger.
You know what I've noticed? Everyone is talking about AI these days. Actually, if you look at searches and mention of AI online, you can see a clear uptrend years after years. And I didn't know this, but AI is not something new. It actually started over 65 years ago. But now we finally have a cost efficient way to store, transfer, and compute a massive amount of data in a way that was never possible before.
Now that you mention, at some point I realized that all the tech newsletter I subscribe to, whenever I receive an update, almost every time there's news about AI. And whenever I see a news related to AI, I think of Nvidia.
From my basic understanding, Nvidia is known as the best company in the world making GPUs to enable more efficient processing for video games. And nowadays, most AI programs heavily rely on good GPUs.
Yep, Nvidia has generated massive gains over the past 12 months as they continue to sell more gaming and data center GPUs. I'm sure many investors missed this bull train, but should they consider getting in now or is it too late?
Oh, let's break it down a little and see. Nvidia's revenue went up 53% to 16.7 billion in 2020, and in the first half of 2020, Nvidia's revenue soared another 75% year over year to 12.2 billion. This growth was mainly driven by its GPU businesses, which is about 83% of its revenue last quarter.
Well, I'm not too surprised. Their gaming GPU business is making bank throughout the pandemic. And don't forget, the demand on its chips that people use to mine cryptocurrencies is still very high. As the technology expanded in the recent years, now their GPU is widely used to run AI programs.
Yep, and aside from dominating GPU market in both the private and the public sector, and their AI chips are already widely used by cloud service providers and in self-driving cars.
You know what? I just love how diversified their product line is. And with Facebook's entry into the metaverse, Nvidia will definitely benefit from this. Or I rather say, they will make a lot of money from this young industry.
Yeah, and Nvidia is building the future of internet, according to Zuck. But don't forget, in the short term, they're still having a hard time with the global chip shortage since they're a fabless chip maker that relies on third-party foundries. They raise their prices to offset the troubles of slow productions and late shipments. But still, analysts still expect Nvidia's revenue to increase by 55%.
Nvidia trades at 55 times forward PE right now, and those valuation might seem high, but I guess it is still reasonable in today's market. We should know that Nvidia's 40 billion bits for ARM, which would add the world's top mobile chip designer to its portfolio. But this is not a sure thing yet. and we probably need to reevaluate the company if this acquisition falls through.
I agree. The stock price will definitely dip without ARM's licensing business because currently it is already priced in.
Yep. Personally, and I'm sure we both agree, this is an interesting stock. I'm an investor that characterizes myself as having a medium risk tolerance. One of the things I like the most about it is the fact that it is an established player in a very lucrative industry, which is essentially dominant. And the industry is growing at a very fast pace, and so is Nvidia.
For sure. And if you're looking for a tech company that's on the cutting edge of its fast growing AI market and never have to worry about the competition, Nvidia is your pick. They're not only a leader in this AI chip sphere, but it also maintains the biggest market share of all other GPU markets in the world. With their strong financials and high demand for its services, we should expect this company to hit 1 trillion very, very soon.
I think they can hit it next year at this rate. Well, nice opening weeks for November. All major indices, including small cap, hit a new all-time high. So what do we have this week? Patient Fed, strong earning, promising COVID-19 pill that reduce hospitalization and death in clinical trial, and strong job number gains.
Good job, Powell. You'll probably get to keep your job. He announced that they will begin tapering its monthly bond purchases by 15 billion per month. At this pace, the Fed will phase out entirely by middle of 2022, so around June. With the current inflation running high, the fear is that the Fed might be forced to hike rates sooner than rather than later. But Powell came out and said that the Fed will be patient on the rate hikes. Take a guess on what will happen to the market after we hear that.
Well, everything goes banana. Here's a graph showing market-based expectations for Fed rate hikes next year. We now expect a little less than two rate hikes. Beside the positive outlook for the Fed, the US economy added 531,000 jobs in October and unemployment down to 4.6%.
More new jobs added, unemployment rate trickling down month after month. Equity market makes new highs week after week. Consumer spending is back to pre-pandemic level. Bitcoin back to 60,000. Everything is looking so normal and it just doesn't feel right to me.
That's what I've been thinking lately too. It just feels so calm, and with the tapering, which is not tightening, the central bank will continue to inject stimulus over the next 8 months, just at a slower pace.
I guess we trade day by day then. Nothing much to talk about in this week's market. All major indices have run up parabolically in the recent weeks. Small cap finally broke out, and we have emphasized this in multiple weekly videos. I hope you all bang from this.
Absolutely. Remember to always secure some profits. Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.